Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, head of Spider America's research at State Street Global Advisors. We are talking about GICS changes that will impact many popular sector and industry ETFs. So it is very important for investors to understand how the reclassification will affect their portfolios. Matt, welcome back. Thanks for joining us to explain these important changes.
Yeah, thanks for having me back. And the changes are significant, and I think are noteworthy for particularly sector investors, but also just S&P 500 folks as well.
Right. So these global industry classification standards, or GICS as they are popularly called, they provide a framework to classify companies to a particular sub-industry or to a sector according to their principal business activities. And these annual GICS methodology review is done every year to make sure that the structure continues to appropriately represent the equity markets. So last year, after conducting the annual reviews, S&P Dow Jones Indices and MSCI announced these changes, and they also published the full list of companies. And these changes will go into effect in a couple of days, that is on March 17th, after the close of trading. So to start off, could you please give us an overview of these changes?
So the changes are impacting principally basically six sectors. We have information technology and financials impacted, information technology and industrials impacted, consumer discretionary and consumer staples impacted. And then the last one, there's sort of some beneath the surface stuff going on that's not so important at the sector level, but I think is noteworthy within real estate. But I'll sort of just focus on the big changes. And the biggest one is within information technology and financial services, or financials, I should say. So what is happening is that the sub-industry of data processing and outsourced service companies are moving from tech into financials. And some of these names, probably people think they actually might already be in financials. And I think this change is more of a modernization of the GICS structure. So Visa and MasterCard, they're currently in the technology sector. They're moving to financials. Now, Visa and MasterCard, they don't actually extend any lending. If you have a MasterCard, you typically have like a bank like Barclays, for example, who actually is the financial aspect of it, the lender of the capital. And Visa and MasterCard are really that tech stack that sits on top of that. But because of what's gone on with financial payments and consumer payments, and even look at things like digital payment services like Venmo or what have you, the financial transaction industry has really changed. So this modernization is moving the Visa, the MasterCards, the PayPals, if you will, from tech to financials. So that really is one of the bigger changes within the GICS framework. That's from modernization. But then there's also the other sort of outsourced service companies. These are your payroll processing, some human resources and employment services industries. These are more software tech stack type of companies, but really they're doing software as a specific service. And these companies like an automatic data processing, a Paychex, Broadridge solutions, those are moving from tech to industrial. So more industrial use cases, those software firms are now going to be reflected in industrials. And then the last big change is within consumer discretionary to consumer staples. And Target, I think if you asked anyone on the street and said, is Target a discretionary or a staple? You'd probably say it's a staple. If you look at their business model, you go in there, you can pretty much find anything, basically what you would find at Walmart. And Target is a discretionary stock now, Walmart's a staple. Well, after this change, Target, along with Dollar General and Dollar Tree, are moving from consumer discretionary to consumer staples, which I think is a nice approach to the classification to really adjust for how retail has changed and how Target has evolved as a business over time, being more of a big box retailer. Overall, like I said, those are 5 main sectors, the S&P 500. The other one is that 6th one in real estate, where some stuff beneath the surface in the industry segment is changing. But we can cover that in a little bit. So basically 5 big S&P 500 GICS sectors, roughly about 3.7% of the S&P 500 index market cap weight is changing. And in overall, 14 stocks are changing sector classifications. So those are the big high level changes at the sector level.
So these changes are very significant changes, and they all make a lot of sense, as you explained. So they're not as big as the changes that were carried out in 2018 when Google and Facebook, 2 huge companies, moved out of technology and into communication services sector, which was a new or renamed sector. But these changes are very significant. Visa and MasterCard in particular, they're very big companies for $52 billion in market cap for Visa and about $330 billion for MasterCard. These are currently the 4th and 5th largest companies in the technology sector, and they will be among the top 5 companies in the financial sector. So after these companies move out of the technology sector, we will probably see that the giants, Apple and Microsoft, which currently are about 43% of the technology sector, they will become even bigger in the technology sector, right? So how will these changes change the sector valuations, in particular for technology and financials?
Yeah, so I mean, even just looking at the S&P 500 weight, so as you put it, with these movements taking place, the new S&P 500 weight of tech is going to be about 22%. The next largest sector is now going to be healthcare, 15.8%. There are already nothing's happening there. They're going to still continue to be the next largest. And then financials is actually going to see their weight bump up to 14%. So, basically a 2.7 percentage point increase overall. What is interesting though is, while within the sector, the Apple and Microsoft might become a bigger weight, when we look at it from a sector ETF perspective, if you look at our tech sector ETF XLK, their weights, they get capped because of risk diversification rules. So basically, 20, they can't be more than 24%, I believe. And so even though some big names are moving out of the tech sector, because of that capping methodology, they'll likely not become more than they would be right now, right? They can't be, because of that cap, they can't be more. Well, now, what I think is interesting is that as a result of that, you sort of see some modest changes within overall valuations. Because you're having some software companies which have higher valuations overall moving to financials. When we look at it on a price to earnings perspective, we see that financials forward price to earnings, price to book, or price to sales multiples, they're expected to increase just modestly. And honestly, there's going to be little impacts within the tech sector just because the valuations are sort of stretched there right now. So fundamentally, there's really not a significant change in the price to earnings or price to book ratios. A modest increase within financials, like I said, but nothing significant. Definitely nothing to the tune of what we saw back in 2018, as you mentioned, when we saw a big reorganization with communication services being formed. Some very big names like Netflix moving from discretionary to communication services. Or even in 2016, when we had a completely new sector created within real estate, carved out of financials. But still noteworthy, because again, some of the names being mentioned that are moving, but also the overall market capitalization of these firms that are moving. I think it is noteworthy, but the actual impact is not as significant as we've seen in the past.
So could you tell us a little bit more about how these changes are going to impact those select sector spider funds? Because those are some of the very popular ETF sector ETFs, and they are very often used by investors to express their views on a particular sector. And also tell us when these changes are going to be implemented in the ETFs, and will there be any tax implication for investors?
Yeah, so like I said, there's 6 sectors impacted really overall. 5 are having membership changes. The 5 are tech, financials, industrials, discretionary, and staples. Our 5 sector ETFs that are impacted as a result of that are XLK, that's tech, XLF, that's financials, XLI, that's industrials, XLY, that's discretionary, XLP, that's consumer staples. Now, the select sector spider ETFs, they're going to undergo a standard rebalance effective at the close of March 17th, 2023. So that's when the index changes take place. With respect to taxes, our goal is to always seek to mitigate tracking error, transaction costs, as well as affect these in the most tax efficient manner. I think we have a pretty strong record of affecting these in a tax efficient manner. If we go back to 2018, 2016, much bigger notional sizes were moving, much bigger percentage of weights were moving, and those were executed in a very tax efficient manner where there was no capital gains taxes created or resulted from those transactions. We can't obviously guarantee anything, but given our history of managing these portfolios, managing ETFs, our ability to trade in different manners, but also use the creation redemption process, the in-kind nature of it, which is a tax efficient way to conduct rebalances. We've done that in the past, and I expect our portfolio management teams to utilize all our skills at our disposal to maintain the tax efficiency that these ETFs have enjoyed over the years. So again, can't guarantee anything, but what we can guarantee is our approach, which has been quite efficient and quite successful in managing the taxability and the tax efficiency of these ETFs.
Right, that is the beauty of ETFs, and that is why investors love them, particularly compared to mutual funds. ETFs are much more tax smart and tax efficient. Now, let's talk about the impact on certain industries and also industry fundamentals. Could you explain those important changes to us?
Sure, and that's the kind of thing is, in talking to some of my team members, that have been referring to these GICS changes like a duck swimming on water. You see the duck moving, and I think it's not much going on, but when you look beneath the surface, the feet, the fins, or the webbed feet, are really just kicking around really fast. And I feel like that's what's going on here is that you see the sector changes, and that gets a lot of the headlines. But when you look beneath the surface, there's so much more interesting stuff going on, and that's at that industry level. And, I think there's, again, sort of 5 industries that are super impacted. Again, and then that 6th one, real estate, is I'll sort of hit that on really quickly because I've been mentioning it. Real estate as a sector, and then they have many, many, many sub-industries. And what is actually taking place, and this isn't really reflected in our funds because we usually just have broad real estate and then REITs. But what is happening is that within that REIT space, they're creating many more subdivisions of REITs, breaking out some of the specialized REIT categories, creating more sort of consumer-related REITs. So some really interesting stuff going on in the REIT space where you can maybe carve, slice and dice, and package the new REIT sub-industries into a consumer-oriented REIT versus a sort of office space REIT versus like an industrial REIT, specialized REIT. So that's what's going on in real estate. But as it relates to some of the broader industries in where we have funds, the 5 that are sort of being impacted are banks, so KBE, and that's really a minor one where residential mortgage and commercial mortgage sub-industry is being added. So thrift and finance mortgage is being discontinued. So that's really not that interesting. The bigger ones are within software and services. So we have an ETF XSW that seeks to track the S&P Software and Services Select Industry Index. And because of those data and processing outsourced service changes, right, the Visas, the MasterCards, the Paychecks, as I mentioned earlier, because they're no longer going to be classified as software and service firms under the technology sector, they're being stripped out of that software and services index. And basically, right now, there's roughly 198 constituents. After the changes take place, there will be 156. So 42 names are being removed. That's 22% of the overall exposure from a market cap perspective. So a big change there, and really sort of going to be focused more on these software companies, application software, some consumer software products, things along those lines. The other one is within the internet ETF that we have, XWeb. And that's because the internet and direct market retail sub-industry is being discontinued. So those companies that were in the internet and direct market retail and that sub-industry will now be removed from our internet select industry. So those are things like eBay and Amazon, the internet retail. So basically 15 stocks are being removed from that, roughly 30% of the weight. So that is going to be more your traditional internet stocks, not the internet e-commerce. Then the last one that has a notable change is within retail. So within retail, the department stores and general merchandise stores and the internet and direct marketing retail, those are being discontinued and more broadline retail is being included. This is a minor change. Only 5 stocks are being removed. The last one, which only has some minor classifications within transportation, that's XTN. There's no real change of additions or deletions. It's sort of like the bank one where there's just the beneath the surface impact on some of the more granular sub-industries are changing. So some pretty big changes, mainly within that software and services industry. Largely, though, the impact, if we look at it from a market capitalization perspective, it's very similar, still very mid and small cap heavy on that exposure. So roughly you would have, about 60% of the weight is going to be a mid and small cap. Right now, it's about 55%.
Excellent. Now, switching gears a little bit, I wanted to talk about ETFs flows too, because I know you track flows very, very closely. And this year, ETF inflows have been rather lackluster, which is somewhat surprising because last year, US listed ETFs had pulled in almost $600 billion, even though market conditions were so challenging. So earlier this year, we saw some interesting inflows into fixed income and international ETFs, and lately cash ETFs, short-term treasury ETFs have been quite popular. So could you tell us more about some of the ETF inflow trends that you have seen?
So the ETF flows have been frustratingly low. I think that's the first point, is that basically you have low flow totals in both January and February. And 2023 is off to its worst start to a year since 2019. And I think even if we look towards the first 15 days of March, which have been very volatile, obviously what's going on within the banking industry, roiling markets, which continues to change day over day in terms of the financial stress that's being placed and what the Fed policies are going to do as a result of that. But so far this month, in the month of March, we've only had about $4 billion of inflows into the ETF industry. And it's really just been into fixed income. And when you even dig a little bit deeper into that, the fixed income area that's been gaining flows has been the ultra short government bond, sort of cash-like type exposures. Those have taken in around $8.8 billion. And if we look at that $8.8 billion, if the month was to end today, that would be the 7th most ever that ultra short government bond ETFs have taken in for any given month, and we still have half the month left to go. So what we have seen from the flows is that there's a lack of risk taking. That we see sector flows, their net outflows once again this March, about $1.5 billion. Year to date, sectors overall have outflows of $7 billion. We've seen, again, this could be a little bit different now. Because of the options market that exploded within specific banking ETFs. But options volumes and options open interest was low relative to history, basically in the bottom 13th percentile. And we saw short interest levels also decline. And to me, taking all those together, so low flow totals, low options positioning, and a lack of short interest, which even though that's a negative bias, that's still risk. Taking all that together, and that's a very low risk taking environment. So that's sort of explaining some of the low flow totals. There's a lack of willingness to express significant risk. We've seen outflows in the U.S. equity exposures and mainly inflows into international European. So that's sort of the big picture from a flow perspective.
Yeah, definitely very interesting trends. Matt, thanks again for joining us today. Always a pleasure to have you on the show. Thanks for sharing your insights.
Yeah, thank you for having me on.
That was Matt Bartolini from State Street Global Advisors. Let's quickly recap some of the important ETF tickers that would be impacted by these changes. Matt mentioned the sector spider ETFs, 5 important ones: XLK, the technology ETF, XLF, the financial ETF, XLI, which is the industrial ETF, XLY, the consumer discretionary, and XLP, the consumer staples. Now, Vanguard also has some very popular sector ETFs, and those will also be impacted by these reclassifications. In particular, the Vanguard Information Technology ETF, ticker symbol VGT, Vanguard Financials ETF, ticker symbol VFH, the Consumer Discretionary ETF, ticker symbol VCR, Consumer Staples ETF, ticker symbol VDC, and the Industrials ETF, VIS. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe to our show so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.